Welcome to Non-Consensus Investing. I'm Ram Ahluwalia, your host and CIO at Lumida Wealth, where we specialize in the craft of alternative investments. At Lumida, we help guide clients through the intricacies of managing substantial wealth so they don't have to shoulder the burden alone. Through this podcast, we draw back the curtain to reveal the strategies employed by the best in the business for their high net worth clients so that you too can invest beyond the ordinary.
All right, there's so much happening around the US consumer. We've got delinquency rates are up, provisions are building. We have the bank set to report soon. And I've got a very special guest, an old friend, Will Black. So Will is an expert in the world of consumer credit. He's the founder of Black Analytics, a leading consulting firm on consumer credit and structured finance. He spent 25 years at Moody's leading consumer structured finance, the ratings team for the US, covering everything from student loans to auto leases to Tesla securitizations, maybe even SoFi securitizations. And he was also part of Morgan Stanley's treasury team, where he managed multi-billion-dollar issuances around structured finance products. So, Will, great to see you again. And thank you for joining Lumida Non-Consensus Investing.
My pleasure, Ron. Great to see you too. Looking forward to this.
Likewise. Well, let's dig in. So what's the health of the U.S. consumer? We see debt going up. We see auto insurance premiums go up. We see DQs going up. We're hearing headlines about people are being tapped out. Lay it out for us.
Yeah, I mean, there's a lot to dig into here. I think I'll start off first by just saying that it's a bit of a paradox, some of the degradation in credit performance that we're seeing, at least when you zoom out and you look at the economy as a whole, in terms of some of the headline macroeconomic statistics. There are some things to point to that are quite strong. Again, I think we're going to talk about big picture and averages, at least to start out with. And obviously something's getting lost in the averages or the headline numbers, so to speak, because if you look at GDP growth, the U.S. economy is punching above its weight. We know that, 2/3 of the economy is built on consumer spending. A lot of that is done on credit, right? Nobody likes to spend money they don't have, quite like Americans, I like to say. And a lot of that done is through the securitization market, which is my wheelhouse and is a good kind of vantage point to see how companies interact with consumers and how they finance those activities through the capital markets in a very granular way. So again, zooming out, GDP growth punching above its weight. Like I said, the labor market, you might say it's picture perfect. You'd really have to squint hard to see something that was negative there, even with respect to the dreaded wage inflation, and income inflation, which has not materialized in a worrisome way. What I mean by that is, of course, I don't think economists have been too concerned about a wage price inflation death spiral in recent months. That seemed to see that concern, which is a legitimate concern, and it has seemed to have abated. I think the last time I looked at wage inflation data, that we're getting pretty close to where we were pre-pandemic. So we can put that also to bed. Again, you really have to look hard at, I was looking at some JOLT data, some job layoff announcement data from the Challenger report. Really nothing to point to other than maybe you might call it a normalization at best, but you certainly wouldn't call it a softening of the job market. And the reason I dwell on the job market is because this is like, ground zero of the health of the consumer. If you have a job, you're much more likely to pay back your debts. So that's strong. It's true that consumer credit, consumer debt levels are at record high. They're at $17.5 trillion. That is the highest they've ever been. I'm talking about mortgage, credit cards, autos, all the consumer credit categories stacked up on each other. That is very, very high. But I like to look at that not as an isolated nominal figure, but look at that in context of personal disposable income, which is, a good Fed statistic they call the debt service ratio. that ratio, which is, I think, more intuitive, right? It's more how maybe, well, credit professionals, but also kind of person on the street may view their financial resilience, their financial profile strength on a relative basis is, can I make my monthly payments given my income? And that ratio is at historic lows right now. And I think there's actually a lot of gravity to that ratio. What I mean by that is, I don't think that leverage ratio, that debt service ratio, is going to go up. I think it will go up, but I don't think it will go up by much over the next probably several years. And why do I think that? It's because it's largely anchored by something that we saw happen during the pandemic. And that's what I refer to as the pandemic mortgage refinancing boom. And so yeah.
Let's interject a few things there. So one is, so labor market's healthy. That's
Yep.
one. So incomes are good, and we're not seeing wage price spiral. That's healthy too.
Yep.
But we are seeing delinquencies go up.
Yep.
So how do I reconcile strong labor market?
Right. And the other thing that I would point out is, I'll get there. The other thing that I would point out is that underwriting, by various soft and hard data points that I follow, are also indicating, at least for the last couple of years, have been tightening. So you're right to point out the fact, what is this? Why are we've been seeing delinquencies rise. I've been writing about it for about a year and a half now. You see kind of an inflection point in the delinquency rate in autos and credit cards. And I will tell you, again, the data that I kind of focus on is coming from the Fed, shows that there was an inflection point, like I said, about a year and a half or so ago. Those delinquency rates, 30 plus delinquency rates for autos and credit cards, are now past where they were pre-pandemic and on a trajectory that, at least in the case of auto delinquencies, puts them kind of in danger of hitting where they were during the great financial crisis, which is absolutely remarkable given, again, the strengths in the economy, and even by indications, the strengths in underwriting that have been in place for a long period of time.
That? I mean, the income generation is there.
Right.
Why isn't, and you just shared that the debt service coverage ratios, meaning the income required to support the debt, that's at a manageable and, in fact, a low level, but yet we see these DQs increase. And you just said the underwriting is tightening, improving.
Right.
How do you explain the rising DQs?
There are a few things we can point to. I'll start off again kind of broadly how I would paint the picture. I call them intersections of risk. These aren't novel risk factors, but I think if you look at them kind of, again, as intersections, if you look for transactions or asset classes or sub-asset classes that have these features, you're going to find where the risk is most pronounced or most amplified, right? So first intersection of risk is the age of the borrower. Okay. So here I've written about this, name your asset class, but I've written about this a few times in my newsletter. The Gen Z and millennial cohorts, which are, sizable cohorts in terms of their age categories, are showing they're always riskier, those cohorts. Why are they riskier? Because they haven't hit their peak earning years yet. They haven't built up the kind of reserve, or call them buffers, to navigate the choppiness that sometimes accompanies that stage of one's life. But what you see in the delinquency data is that, again, a huge separation that you really have to go back to the great financial crisis between, for example, those younger cohorts and the older cohorts now in terms of delinquency rates. So again, why is that happening? They're riskier. Okay, the credit stacking, ordinal ranking makes sense, but the distance between them and the other cohorts is a bit of a head scratcher. And I think the answer really goes back to that point I started to make about the mortgage refinance boom during the pandemic years, right? And the fact that we know these cohorts, Gen Z and millennials, have had what is referred to as delayed household formation. They've hit those milestones much later in their lives, if they've hit them at all, relative to some of the older cohorts. So they were not then able to participate in the refinance boom to these very, very low levels that took place during the pandemic.
So they couldn't tap the home equity appreciation
Yep.
from having an investment in a house, which for many Americans is their largest investment. They have it on leverage through a mortgage.
Yep. 65%. This country now has a 65% home ownership rate. So that leaves a very large percentage, 35 by my estimate, that they don't own their homes. And so they have been, subject to the prevailing winds of shelter inflation, which have been, of course,
which been going up.
Exactly.
And, the main complaint you hear from millennials and Gen Z is, hey, I can't buy the $40,000 house that my parents did in 1977, and I'm priced out. And now they're forced to rent. Rents are going up, and they're choosing to remain single for longer, which makes it even harder to purchase or qualify for a mortgage because you don't have the dual income support.
That's right. And just to put a finer point on just how much benefit these homeowners. So I think I said 65% of households, own their homes. I think the number is 60% of them have a mortgage outstanding, because some people have paid off their mortgage and they don't have a mortgage at all. But 60% of them have a mortgage. So it's still a great proportion of Americans were able to take part in this refi boom. How good was this refi boom for these borrowers? 75% of them refi during this period of a window of just a couple of years. 80% of them have a mortgage rate below 5%, 60% below 4%, 25% below 3%. Those lucky souls.
Yeah.
What's that?
I'm in that bucket, the 2.5.
Oh, good. Well, you're lucky. Yeah, and so you're not going to move anytime soon.
No.
Everybody pretty much everybody in those buckets is going to be locked in unless, some external force pushes you out.
Death, divorce, there's one other driver, relocation for a job.
Right. All of the above. And look, if the economists are right and we're in a higher for longer rate environment, that's going to add, again, kind of gravity or an anchor to everyone's current home and mortgage situation. Again, this is a great tailwind in many respects, but it also has negative consequences. We can talk about that in terms of affordability and other, creating this kind of, sometimes referred to as a tale of two cities, where you really have a distinction growing between homeowners and non-homeowners. So that is one of the intersections of risk. So I pointed that one.
That's one of the drivers, is that the population that didn't benefit from the mortgage refinance, their DQs are going higher and they're younger. So that's driving some portion of the increase in delinquencies that we're seeing.
Can you rephrase that?
Is the increase in delinquencies coming from that population that did not participate in the mortgage refi?
An outsized proportion is more than normal. Yes, that is a contributing factor for sure. Yes, gotcha. To answer your question.
Okay.
So the other intersection, so number 2 out of 3, is what I refer to as basically the subprime component here. Okay. Now, again, you might say, well, yeah, subprime always performs worse. True. That's certainly what you would expect to see. And in fact, what we have always seen. The data that I'm looking at shows, when you look at the FICO ranges organized by subprime, and in this case, I mean FICO's below 620. And then the rest of the range above that is divided into near prime and prime, call it, or sometimes it's referred to as prime and super prime. Doesn't matter the nomenclature, but those that are much higher credit quality obligors. Again, the separation between the delinquency rates is widening, where you see the delinquency rate of that riskiest strata of borrowers by FICO score is far and above this. In this case, it's even above where it was during the great financial crisis. So there's something outsized, amplified happening to that cohort of borrowers. And that's a bit of a head scratcher too. But I have an answer, or I have at least something that I want to point listeners to as, I think, a worthy report put out by the Fed recently. I mean, it was put out this January. So it's a 2024 report that tries to explain this. And I think they do a pretty good job. It's an analysis that basically observed the secular trend in this riskiest cohort of borrowers has been shrinking since the great financial crisis, which kind of makes sense, right? Because, lower for longer, people have been rebuilding their finances. And so that measure of risk, that FICO band of risk, I can imagine the population basically graduating into the next higher buckets, right? And so on.
Right.
That trend of shrinking of that cohort actually accelerated, meaning it got even smaller during the pandemic. And that's for reasons that we've talked about, I think, where, there were fiscal transfers and subsidies and relief measures and so on that, again, nominally improved the financial profile of many obligors during that time and lifted their FICO score. That has the effect of, I sometimes refer to it as adverse attrition, out of that already shrinking population into the much larger buckets above it. So it didn't have much of an impact to them. They still default and go delinquent as they were, let's just assume. And then, but if you're defaulting and going delinquent in a much smaller pool, much smaller denominator, it's going to be amplified just in the simple math of it all. And this report tries to gauge or measure just how much of an impact this kind of mathematical FICO inflation had by holding steady the FICO, the debts in those FICO strata at the beginning of the pandemic in 2019 through the next 3.5 years. And that actually explains about a third or more. Actually, what it has the effect of doing is it brings those delinquencies that are crazy high that I mentioned back down to where they were pre-pandemic. It has a very significant impact.
That's significant. So I'll play that back. So first off, the obligor is the borrower here for the audience in case folks don't know. And what you're saying is, so we had great inflation in FICO, right? So the same FICO score today isn't the same FICO score from 7 years ago. A FICO 750 today is not as high credit quality as a FICO 750.
I wouldn't put it that way. I mean, there is that narrative too, and that may be caused by other things that have happened over the years, like the suppression of certain debts from the credit bureau files. That has by some people's accounts, added to the kind of FICO inflation that you're talking about, that they don't mean the same thing. That's not exactly what I'm describing here. I'm talking about more of kind of this graduation of borrower from one bucket to another. I might be splitting hairs here, but I think there is a distinction with a difference.
I see. The composition of borrowers is changing because they're graduating to higher credit quality. Okay. And so when you look at those DQ levels increasing, though, like the primary cohorts that are driving that, I get it's the young and don't own a house. I understand that subprime has a role to play there, but subprime as a percentage of overall debt is relatively small.
Yes.
So is that enough to move the needle on explaining an increase in delinquencies?
Again, so I'm going to mention the three. I haven't gotten to the third one yet. Not one of these things is enough to move the needle, I would argue. Okay. You need all three, and then you start to see some additive effects. And look, from my perspective, I tend to focus on securitized consumer credit, which amplifies this effect even more because, you're talking about then discrete pools of assets. So maybe I'll get to the third lane here, and then we can kind of back up and try to put all the pieces together. But the third aspect that I like to think about when I think about why we're seeing these outsized delinquencies and so on has to do with underwriting. Getting back to my earlier statement, yes, it's true. We've seen tightening of underwriting. It's certainly stable. I would argue that we've even seen tightening by the soft data that I showed, that I talked about from the Senior Loan Officer Survey, tightening for the last 7 quarters, right?
Right.
Okay, that's been happening. But if you go back beyond 7 quarters and you actually look at that same survey during the teeth of the pandemic for, I think it was 6 consecutive quarters or something like that, the senior loan officer survey was indicating market loosening going on.
Yeah.
Okay. Well, it takes a while for that loosening to manifest itself. It doesn't happen instantly, right? Those looser underwriting standards were applied to loan underwriting back then.
Okay.
Now, again, what was it? Just almost 2 years ago, you started to see an inflection with upward trends in delinquencies and so on. Probably that was a contributing source of the delinquencies. By the way, contributing to that even still further is the exhaustion of the pandemic, largesse that was in the transfers and the relief. And, now we have also, to add fuel to the fire, we have the resumption of student loan debt. And that's affecting, some 40 million Americans who, for the last 3.5, 4 years, didn't have to make any payments on their federal student loans. And now, as of late last year, are supposed to be repaying that. That's on average a $267 check that they weren't writing for the last several years. So look, it's not as meaningful as a mortgage payment or an auto loan payment, but it's not nothing. And all of this stuff adds up.
Yeah, absolutely.
And the problem with student loans is that it's, along with the resumption or the end of the moratorium and the resumption of repayment, and basically retraining, in a sense, 40 million Americans to start cutting that check again, getting their head around that. Probably many of them thought that they were going to walk away debt-free or at least debt reduced, and many of them
their behavior. They started spending more.
Yes,
they got their skis. Now they're told they got to pay again, and they're offsides.
Exactly. And so that's that. We don't know, by the way, because the data to the bureaus has been suppressed and will be suppressed until the end of this year. We don't know how those borrowers are going to perform or behave. I suspect that, the delinquency rates prior to the moratorium were very high and relatively steady. I expect that we're going to zoom right back up to those rates and maybe go even higher once we start getting data.
Oh, it's now an election issue. If Biden has rolled it out as part of his policy plank, here we are 5 months before an election. And clearly it's meaningful if it's an element of driving DQs for a population consisting of, millennials and so forth, who are not as voter engaged, but increasingly are the older they get statistically. So do you want to just give us a thumbnail on that student loan debt relief program, what the proposal looks like?
Yeah, well, look, I'm reading about it in real time, as I'm sure you are, and many of the listeners have been. This is not as broad or sweeping as the original proposal by the Biden administration was, that was ultimately defeated, by the Supreme Court, or knocked down by the Supreme Court decision. What was it, the middle of last year or so? But it's still pretty sweeping, this proposal, right? So this is a proposal, it's going to get challenged. The proposal, as I recall, if you are a federal student loan obligor, and you fit within the income brackets, I think it's $120,000 for file a single, $240 if you file jointly. If you fall underneath those income criteria, then you are eligible to have up to $20,000 of your loan forgiven. But there's another caveat now. The $20,000 has to, it's limited by the amount of interest that you've accrued above the original balance. Okay. Now, the statistics I saw in a Times report on this said, so don't quote me on this, but I think it was like 20 million borrowers would, by this criteria, would have $5,000 or more forgiven as a consequence of this new criteria outlay, which again is not nothing, but it's not nearly as much as, in round one of this, which again was defeated. In round one of this, if I recall, it was 20 million out of the 40 million. Actually, back then it was 45 million or 43.5 million borrowers would have had their debts completely wiped out. So this is not quite the same thing, but it nonetheless is going to affect tens of millions of borrowers and still, be meaningful, certainly
So
for many
tens of
borrowers.
millions of borrowers and like a median or average impact potentially of $5,000 per borrower. Is that?
Well, I don't know about the median part. They just the report that again face value was 20 million student loan borrowers will have 5,000 or more forgiven, and we know the upper bound of that is 20.
Got it. That's a big
20,000.
number, right? So
Yeah.
20 million times 5,000. That's whatever.
Yeah. It's not tiny. But we're also talking about the biggest category of consumer credit outside of mortgages, right? It's 1.7 trillion. So, it's.
And so the funding source, should that be passed, is the U.S. government, the Treasury,
You and me.
Right. Gotcha. So I wasn't surprised to hear that one. Okay. But all right. So we have a handle now on why delinquencies are going up despite a strong economy. Now, if we're to peel that away a bit more, you've got prime, you've got super prime. Those are like the American Express borrowers, subprime. And we're seeing different effects there too. I'm going to share my screen here. This is a slide from One Main Financial. One Main Financial, Will knows this is a subprime lender. They've been very active in securitization markets for a long time. And here you can see the charge-off rates. Here, this is across a couple different asset classes. We'll come back to the prime, super prime in a second, but from unsecured personal to secured personal to direct auto. And you can see the cumulative losses and how that breaks out by these bucket. And I'm curious, what are your thoughts on the DQs by asset class, especially unsecured personal loans? And I'll frame it up this way. You're already saying that you see elevated DQs in auto. Auto is one of the last to default because you need to drive to work. You need to drive to get your groceries. You need to drive to see your family. And unsecured personal loans are a relatively new asset class, right? We've, of course, had installment loans and loans from, I guess, Maytag or wherever we called them before FinTech lending came about post 2008. But there's no convenience value there. You don't get any rewards points. And we've seen the growth of Affirm, Upstart, SoFi, and a bunch of these FinTech lenders that are originating these unsecured personal loans and buy now, pay later loans. How do you think that they're going to fare going forward?
Yeah, look, this sector as a sector, I'm going to paint some broad brushstrokes and then I'm going to narrow in a little bit because this deserves nuanced conversation. This sector, let's call it, it used to be called marketplace lending. I think now it's called FinTech or BNPL.
Or whatever gets you the highest valuation.
100%. And I think I'm going to deconstruct FinTech in a second, just the word, because I think that's important for people to understand. But back in the day, 10 years plus ago, this was marketplace lending. And they were sometimes labeled themselves as the anti-bank lender, right? They were not banks. They used a kind of what we call rent-a-bank structure. Some of them still do. But many of them have actually acquired bank licenses, bank charters since then as well. So they've kind of
SoFi has acquired a bank charter.
There's a
Lending
few
Club also.
Yep, exactly. Look, they as a category are, in my estimation, riskier products, being personal unsecured installment loans, riskier products than, say, a credit card loan or certainly a secured loan like an auto loan, like you said. I don't think too many people would disagree with that statement.
What would be riskier? I can't conceive of a credit product that would be riskier than an unsecured personal loan.
And so now you start. Okay, so that brings me to the important point I wanted to make, and that is there are certainly intersections and overlaps with this product as a category and some of the other products as I mentioned. And that basically comes down to underwriting and, maybe to a lesser degree, the strength of the brand and One Main here, I am familiar with their story. They have a business model that has been tested. This is actually one of the few personal unsecured installment lenders out there who have been through some serious debt cycles.
Yeah,
in
One
their-
Main knows what they're doing. One Main knows what they're doing because they've got
Yeah.
the relationship. They've got a branch network. For those that don't know, One Main's been around for over 100 years.
Yeah.
It was owned by Citigroup. Citigroup sold it into the 2008 crisis because they needed capital and liquidity. And their delinquency rate is far lower than their peer group. And I think the hypothesis is that because they have a relationship with their borrower, they've got physical branches in their community, number one.
Yep.
Number two, the person underwriting that loan may be able to incorporate some of that relationship data into the underwriting. They go to the same gym, church, activities. There's a sense of reputation and character, perhaps, that might be informing the underwriting process.
I think that's true. I'm not sure how much I would want to weigh that in the final analysis.
Sure.
At the end of the day, the guy that you're seeing in the gym isn't going to help you pay that bill if you're running short. And so it comes down to, look, if times get tight, if consumers are under duress, they've got to make choices about which checks they're going to cut out of their limited funds. And that becomes a question of utility. Back to One Main, they have a long track record of re-underwriting and re-lending to the same lender. So, I don't want to pick on their business model in one way or the other, but one of the strengths you could argue is that they are there and have been there multiple times for the same borrower. So they have a relationship. You might call that utility, right? As a credit card, you have a lot of utility. After you pay for something, you can use the credit again the next minute on something else, and so on and so forth. And your credit line will remain open as long as you keep paying the minimum payment on that card. For installment loans, the loan is dispersed, and that might be the end of the relationship right there, right? That's the risk that you're talking about, is the risk of utility or non-utility in the case of personal. And that is a real credit distinction that will not be evident when times are okay, and it will be very evident when times are not okay.
I agree. And times are great now, as you pointed out, labor market's strong, but there is risk that investors are not pricing in my view. And unsecured personal loans is still an untested category when you see balances at $10,000 to $20,000 on a borrower with $150,000 in income.
Yep.
I wouldn't give a borrower that's $150,000 of income a loan of $10,000 to $20,000 that's unsecured. I might give them a mortgage. I might give them an auto loan for $7,000, but I wouldn't give them
right. Look, it is riskier form of lending, but again, I would say that the nuance here is important, and I would make distinctions as you look at these lenders. What's their experience been? We just talked about One Main being very experienced, by far the most experienced in this category. That counts for something. Also, what population are they trying to address? Are they mainly steering towards the non-prime borrowers, as many of them have certainly started out as being concentrated in those sectors? As I just went through, that's a riskier subsector, and you can expect performance to really come apart when times get tough for that subsector. Or are they concentrated on the prime and super prime? I mean, those borrowers are going to perform well because they are responsible, and they have, from a financial perspective, and they have the means to repay these debts, and they know the consequences of not paying these debts, are going to damage their credit profile and their financial future for other kind of credit milestones.
At one point. So in good times, I agree. Super prime borrowers, they pay their debt. Prime borrowers, they pay their debt. When times are bad, though, what do you see as the multiple on the base delinquency rate? I'm going to leave the witness here a little bit, right? So in One Main's case, in a certain sense, their customers are always in recession. It's a population that, by and large, living paycheck to paycheck. And that's actually one of the advantages of the One Main model, because their DQs don't spike too much in a recession. They do all right. Whereas when I've looked at the prime borrower data, in a recession, the multiple on base rate delinquencies is significant. It's a larger multiple versus the base rate delinquency rate on subprime. So when times are good, DQs are low.
Yeah.
Things are great. When times are bad and job losses happen, then we expect delinquencies to rise at a fast rate. Am I incorrect there, or how do you view that?
So yes, I think the short answer is that we don't entirely know what that multiple is going to be. This is what I think you're referring to when you say a lot of these companies are young and untested because they haven't really been through a severely difficult, prolonged, difficult downturn in the economic cycle. I would not count the pandemic years as being a good test at all.
With stimulus and modification.
Right. Exactly. Right. I would also discount to at least some degree, maybe even to a large degree, a lot of I've heard a lot of the credit folks who defend the call it the sensitivity analysis that you're asking for by bootstrapping their unsecured loan characteristics to the experience of credit cards in the great financial crisis. Yeah, I see you nodding, shaking your head. That is not a good analogy. I think that will lead to understating the true delinquency and loss experience if and when that time comes. Really, when that time comes, right?
Right. No, I agree. We'll see how this evolves over time, but we are seeing a pickup in DQs, including in the prime category, really across credit strata. It's obviously shown up in the aggregate statistics we just saw, and what we don't get from publicly traded personal loan issuers is that detailed vintage analysis. You can see what's going on, and know this will how an issuer can just keep originating new loans to, in a way, stack the deck and to therefore mask the true delinquency rate.
Yep.
By just making more loans. And by definition, a new loan is performing. So when you measure the delinquency rate of bad loans divided by good loans, the newly originated loans fall in the denominator up until they sour. So go ahead.
Yeah. No. I'm just nodding in agreement. I've seen it happen time and again. This dilution effect, if you will, of the true loss number. That's why vintage data is so valuable, because you can isolate that effect. Number one, and number two, when the music stops and you're in that kind of situation where you've been masking the true kind of vintage or underlying credit quality of the performance. Boy, that is an ugly scenario where the bottom falls out and gravity takes effect, and you can see things.
And management, they make forecasts, but when credit contagion takes effect, credit is driving, not management. Management has some levers to pull, but the most important decision was when they originated the loans and the quality of the underwriting, and the relationship with the borrower. And everything after that is risk management. It's how do I minimize my losses? Can I modify the loan? Can I term out the debt in some way? Can I provide some principal forgiveness so that I can persuade the borrower to keep paying their loan? Can I influence their decision to pay back my loan versus the relationship they have with another bank? So this table here shows the DQ rates for Synchrony Financial, Discover, and American Express. American Express, of course, being prime, super prime. We see that the provision for credit losses rose 40% year over year. So the provision, for those in the audience, is the set aside that you have for expected losses. They aren't losses yet, but based on looking at the DQs, which are a leading indicator of future charge-offs, this is what they've set aside. Discover, which is more mass market, their DQ rate has gone up 130 basis points year over year. Of course, they were just bought by Capital One. We'll come back to that topic. And then Synchrony Financial, which is, I would say, more near prime, probably below Discover. And they are 7% quarter-over-quarter increase and a 30% year-over-year DQ increase. So it really is across the board where we're seeing that pickup in DQs. And yet stock prices are going up for most of these firms, right? Discover got acquired. Amex is doing quite well. I haven't checked in on Synchrony recently. Any thoughts on any other comments around prime?
Look, I'm not a stock guy.
Yeah.
I'm a fixed income guy. But I think one narrative that you could tease out of what I've explained so far is that at least some of the intersections of risk you could say are going to burn out. Certainly the underwriting one, right? Eventually those originations burn out. The delinquencies peak and start to become less and less of a factor in the big picture of things.
Well, if you don't grow at the same rate, or you slow your growth rate,
But we
then
saw growth is off the chart. Growth is at record levels, right? Debt levels are higher, not lower. So that's not a problem.
So
As
if
long
you're
as
a
it's quality
lender,
growth.
right? So if you're a lender, you can mask your DQs by growing. You step on the accelerator, you grow. You're going to pay your dues at some point, though, because to your point, they're eventually going to express, and eventually you run limits to growth, right? Because the way you grow is you relax underwriting or you invest in marketing. But there's been a lot of marketing spend already.
Or you get lucky and you take part in a credit positive growth cycle of the economy. That happens as well, and it happened for the last. Let's face it, it happened up until the pandemic for the longest period in American economic history for 10 plus years, right? So that allowed a lot of new businesses to take to form and to gain enough critical mass then to make it through what was their first test, which was the pandemic. And now we're seeing how well they navigated that little ripple in their business model, to their business model. And again, to your point, there are a lot of those companies that just have not really been through a true credit downturn that is prolonged.
It's more model driven. It's math and hope and expectations and other things.
I mean, I keep coming back to this observation. Think about what I said earlier. Is like the delinquency rates and trajectories that we're seeing are bordering on where they were during the great financial crisis. That is astounding. Wow. Think about the abyss we were staring down during the great financial crisis. And now think about this economy. And you're seeing delinquencies shooting up in that direction. I can't believe we're in that zip code. I just can't believe
paradox. No, I agree. It's a great paradox. Any thoughts on buy now, pay later as a category? Of course, this is also a novel, new, untested category. You've got players like Affirm and Upstart that are leaders in that space.
Yeah, look, I admire those companies for being able to scale very, very quickly. And it surprised me, as I'll call myself a veteran of the industry, that there was room for these types of business models to grow as quickly as they have. That personally, that particular credit product doesn't appeal to me, but I am not the target. I'm not necessarily the target audience for that. People do like to compartmentalize their debt, it turns out, right? And there is kind of at least among younger borrowers in particular, and I don't mean really younger borrowers, but people in Gen Z, millennial, maybe even a little bit of Gen X in there, do like to compartmentalize their debt. And there's an I don't want to put things on a credit card anymore because that turned out bad for me during the great financial crisis. So maybe that would be more the Gen X, I guess, that have got stung by some of that over leverage. But that's a bit speculative. I think let's give credit where credit is due for these companies. What they've done right and where they found, I think where they really, really innovated was on the front end, kind of ease of credit adjudication at the point of sale and really embedding themselves in the process for a painless way to pay for something on credit that the stalwarts, the incumbents just hadn't been able to do. So I applaud them for that. Right. Now it comes down to credit, right? They still have to underwrite. They still have a product that, as we just discussed,
there are two innovations. So one is integration at point of checkout. So we're on Amazon.com, we're checking out. You can choose to buy now, pay later, and that works. And the legacy TradFi institutions didn't quite do it. The second is the loss sharing agreements from the merchants that participate in that. I don't have the data on the share and the contribution of that, but effectively, imagine you're a retailer Retailer generally has 50% gross margin. Net margin's obviously much lower, but 50% gross margin, you can afford to shoulder, say, up to 10% of the losses. And you're motivated to reduce the wedge with the transaction getting done by sharing in some of the credit risk extension. That's a clever innovation as well. It's a real, genuine form of innovation. And I agree with you. The asset class so far seems to have been working. It's grown quickly as well.
It's still tiny. It's still tiny.
Still small.
Right.
We'll see how it does. And do you see any distinctions between buy now, pay later and unsecured personal loans? They're obviously both unsecured personal loans, but the use case, the approach, how it's marketed, the kind of customer it might be targeting. Do you see any-
I think that exactly the origination channels differ. I think that might be a distinction with a difference, right? You can imagine, for example, if you have a concentration of your origination funnel coming from one source and that source becomes a problem, right? Then your business model has a risk associated with it that you might have to think about for a much larger, more diversified origination source. I'm thinking of Peloton as one.
Affirm, right? Affirm's one of the biggest customers or channel partners.
I mean, so Peloton was, everybody has it. I happen not to have one, but I mean, is every other person maybe has a Peloton in their apartment or their house somewhere?
I got one that's like dust in my basement. I will sell it to anyone here. It's almost never used. I'm going back to the gym. So,
but for a while they were the hottest thing going, right, during the pandemic, and then they've fallen. They've fallen on harder times, as I understand it. So. Right. That can be an example of
that's more of a business model risk, right?
Yeah,
if they're channel partner, or if they try to internalize financing themselves, right? If Shopify says, "Hey, look, we'll take the credit risk ourselves," or Amazon. All right, great. Well, let's shift gears and talk about auto insurance. So, what's happening in the auto insurance space? What does this mean for the consumer?
Yeah, I wrote an article about this a couple months ago, and I was looking at the inflation data. The granular form of that report. And one of the line items that just kept standing out was auto insurance. Despite, now we know that, we were looking at new car prices and surprise, used car prices for a long time were appreciating. And inflationary pressures on both of those categories have now come back down. That's good news on those fronts. But what is happening still is that insurance rates continue to rise. So it just caught my attention. And it turns out that, the average insurance bill now, I think it was around $2,000 a year, something like that. It had increased, I think, over a 2-year period. It's been a while since I looked at that article, but I think it was by 40% over.
Yeah, I've seen my premiums go up. Yeah, auto insurance premiums are going up.
So this is not captured directly in loan performance data, but it is obviously an incremental expense that borrowers need to pay. And by the way, we're focusing on auto loan insurance or auto insurance premiums here. It's also true in the housing market as well, which is also taking up a lot of the headlines.
And that eats the marginal disposable income for the consumer, and
all of the Yep. So this is a factor. This is yet another factor. This is what happened. And one of the takeaways from my article is that, there is momentum behind this increase in insurance premiums for autos, because the insurance companies, what happened, and I was surprised to learn this, during the pandemic, a lot of people stopped driving, and then, the limitations eased up, people started to travel again. And apparently people forgot how to drive because, and I say that only partly tongue in cheek, but accident rates went way up. And the other thing that's going on, if you want to look for a real poster child for super high auto insurance policies, look no further than Tesla, right? Because on top of everything else that I've just talked about, Tesla's got that, vertical business model. And, try getting your Tesla repaired or your parts replaced if you, God forbid, get into an accident and so on. Though their premiums already are higher than most other vehicle premiums. and they're also going in the same direction. So yeah.
Has anyone done the math on what the incremental cost of auto insurance is for a Tesla versus the savings from not having to pay gas on a Tesla?
Oh, that I haven't seen, but I have seen articles. I don't remember what the dollar numbers are, but it's appreciably higher. The premiums are than I mean, well, you have to build in a lot more than just the insurance premiums there, Ram. I would argue you need to also, Tesla cars are more expensive than ICE, internal combustion engine vehicles as well. So you're already paying me a premium. I think I saw, I don't know, somewhere between 3 and 5 years is the break even. And that that of course depends on A, how much you drive, and B, how much gas is where you live, right?
Right.
And also how much electricity is where you live, right? Those three things. So the math is not simple on that, and it's regional.
So higher interest rates are putting a wedge between consumers and their Tesla, right? Elon Musk and his CFOs talked about this on their earnings call already. That's one.
Yeah.
Then you got higher insurance premiums. Then you got higher competition from China and other EVs and also hybrids. It turns out like demand preferences need to be shifting. People, it turns out, like hybrids or they like ICE, etc. Here I've pulled up one of your reports where you're looking at the residual value. So the residual value on Teslas have also dropped.
Yeah.
Because in the primary market, Tesla's just charging less for a new car. I presume that's the main driver. Do you want to share some of your insights from this report?
Yeah, sure. I mean, look, the takeaways here that, anyone who's paying attention has seen Elon and Tesla generally dropping the prices for many of the models, in some cases multiple times and by several $1,000s at a time. So they're doing that. Why? Because they're competing now in earnest from other stalwart manufacturers. Now, the Chinese certainly aren't a factor in this country.
Not yet.
Not yet.
Depends on how tariffs play out and all the rest, right?
Right. But look, that's happening. And then you mentioned a change in consumer preferences now for hybrids versus pure electric vehicles. That's also affecting the demand for the only kind of vehicles that Tesla produces, which are these, full pure play electric vehicles. So that's also, another factor. So look, I'm not second guessing Tesla's decision to lower the prices of their cars. That's their inside baseball move to do what's best for shareholders, I'm presuming. But again, I'm going back to my securitization kind of roots here. If you bought a security that's backed by Tesla leases, well, a large part of that risk is what's called the residual value risk. That's how much the vehicle is worth when you trade it in at the end of the lease. And you think it's worth something when the lease starts, and you're building in some depreciation, but that depreciation curve is now being adversely affected, arguably, by these unanticipated decreases in the prices and relatively aggressive decreases in the prices of these models, right?
Right.
And another way of putting it, it in very stark terms, how would you feel if you bought a Tesla today and then tomorrow the price on that Tesla dropped by $3,000?
You feel like
too happy.
Right. You feel like you're upside down, that you should have waited.
Right.
You would tell your friends to defer purchases, right?
Right.
And I agree. They're acting in their best interest. They have to lower prices.
Right.
Because they've got high fixed costs, lower marginal cost. The EV is a battery, some semiconductors, wheels. They've got a good process in place. But now you have cars from China. They're not marketed here in the U.S., but Tesla does compete with China auto manufacturers in China.
Yep.
And now you're seeing price points at $10,000.
Yeah. Look, the U.S. government is, of course, I don't know, challenging. And I think Janet Yellen was just over there, having some pointed remarks about concerns around, in my words, not hers, dumping practices.
I guess like zooming out,
Yeah.
why do we care if China's offering U.S. consumers a discount effectively, right? If they're subsidizing, why do we care? It goes into the bottom line of the U.S. consumer if they are
I
dumping
think,
and sub.
well, the economic argument and political argument is that you're hollowing out you're disguising the true cost of manufacturing, and you're using the largesse, in their case, of the much larger government to put your thumb on the scale of competition, and therefore hollowing out then the U.S. ability to compete. And that has the deleterious effect on, of course, not only our manufacturing capabilities, but also the quality of lives of working,
That's
working
the
Americans.
you made the industry case and the union
Yeah,
case. Like
yeah,
ultimately, like there's a wealth transfer from the government of China to buyers of any product that they've subsidized.
yeah.
And free markets and capitalism about advantaging the consumer versus a special interest or a group. And look, I haven't studied the dumping, the levels, all the rest of it. We're just exchanging a couple quick views here, but if a country wants to offer me product that's well below market price and to our population, that's a gift. That's a boon. And yes, there's some
I think
costs
the political and social dimensions to that, when it's done at scale, I think really start to pollute that argument and weaken that argument. In my view, I look. You're. I don't. I'm going to say something that definitely dates me, but I can remember when I was a fairly young child, a very young child. I can remember, when Buy American, when the Detroit Three were starting. This is when they were starting to lose their top position to then it was the Japanese automakers who were undercutting them in price and producing higher quality automobiles. And there was a move then, you have to buy American. And certainly I grew up in the Midwest more or less. And, there was a lot of pressure on people to buy American for a long time. You and I both know, you stand back from that. It's like, no, that you can't reward poor manufacturing and quality indefinitely without, rewarding mediocrity in that case.
Yes.
And that also has its negative sides. That's not the dynamic that we're talking about now. I'm just saying that there are kind of two ways to look at this dynamic. And definitely when you look at it at scale, which is what we're talking about here, there are social and political dynamics that complicate the economics.
I agree. Look, it's a loaded topic, but you're right. Like if you go to India and you drive a car, you're driving a car made from like Tata or Reliance, and these are not cars like you might get from brands that we recognize. And that takes place because India is protected from competition. That does not help the billion consumers in India. It helps a couple large corporations and the families behind those corporations. So competition brings out the best in everyone. And free markets lead to greater specialization and comparative advantage. And nations specialize also. The United States specializes in many things, a high-end technology being one of them. Japan, of course, specialized in auto, and China is now specializing in EVs, as they should. So, the idea that one
Don't
country
forget solar panels. So
and solar panels,
that's a good example of, again, this kind of political dynamic, but and accusations. I'll put it that way because I don't know where the final decision was made on dumping, concerns about dumping. Right? And you've seen, in some fairly high profile cases of American solar panel manufacturers go under, even with the help of the government. Right? So that's happened.
Right. It reminds me of like when the antitrust regulators went after Microsoft for not charging for the browser. It's like, well, it's in the consumer's interest if it's free. Like I get the argument around bundling and tying and look, there's definitely anti-competitive practices when you require, for example, if you're in Amazon, a third-party merchant to also use your fulfillment and break in pricing. And these are hard issues to tease out. You could see it benefiting the consumer. You could see it as limiting competition in some other respects. But and don't know, my bias would be to encourage a world of greater specialization, comparative advantage, and unless you have a strategic industry, the strategic industry would be something like defense, national security,
Right. Right.
something 20, 30 years that's impacting the trajectory of the nation.
Like TikTok.
Like TikTok, right? Right. Like the future of our children's brains. Yes. That is strategic. That's strategic. Right. But EVs doesn't, in my mind, meet that standard. But in any case, well, what else would you like to share, Will? This has been a lot of fun. We've covered a lot of ground. Any concluding thoughts, remarks, or topics we get? Should we talk about Discover and Capital One?
Yeah, we can touch on that real quick. I think that was an interesting announcement. It hasn't been finalized yet, but the headline was Cap One is going to purchase Discover Card turnkey, the entire shooting match. Discover, these acquisitions of this size don't happen every day, so it is meaningful. It vaults Cap One to the top of the leaderboard in terms of credit card issuers, in terms of receivable size. I think Discover, in round numbers, Discover had about $100 billion credit card portfolio. I think Cap One has about a little bit more than that, maybe $125 billion. So this definitely puts them even higher than Citibank, which had been or is the number one currently.
You think
so that's sizable? Yeah.
Sorry, real quick. Do you think there's an objective there to become closer to a GSIB? Is Capital One trying to bulk up so they can qualify to be a too big to fail bank and get some of the benefits and treatments from that?
Gee, I don't know. Is that a desirable court to be in?
I think so. I think you get cheaper funding. You're not going to get bank runs. Remember in March, April, you had the flight to quality. You had the influx of deposits, and then JP Morgan still paying 0% out to depositors.
Right. But I guess what I meant by that is, do you want to be in that club, or do you want to be just on the edge of it and kind of be assumed to be in that club without being in it? I'm just wondering if you want to tread that line as closely as possible without crossing it.
It's a good question. I mean, the trade-off is the compliance burden, which is
right.
onerous, significant, and not to be dismissed. But once I think the threshold's gone up. But if you're just outside the club, you are at an onerous threshold already.
Right.
I think the worst spot to be is you're just outside the club, because you're shouldering the burden of compliance, but you're not getting the too big to fail benefit that would allow you to offer 0% deposits to your clients and benefit from flight to safety.
That's fair. I don't know if that's part of it. There's a lot of things. And one of the things that I pointed out in my article that I wrote about this at the time was Cap One is not only getting credit card receivables. Okay, so they're getting an increase in market share. Look, the credit card business model is built around economies of scale. So this certainly helps in that regard. But they're also getting, importantly, a network. So just, for the folks who may not realize this, but there are 4 credit card networks. I think of them sometimes as the rails on which your purchases run to basically connect all of the parties and make credit work at the point of sale. There's Visa and MasterCard, of course, the 2 largest by far, and then the much smaller players in the network businesses are American Express and Discover. And Discover's been around since whatever it is. I'm going to say that 1980s, maybe even back further than that. But they've never really taken off as a credit card in terms of being able to break outside of maybe the high single digits. I might be wrong. Maybe they got to the low double digits at one point, but certainly I think they're still in the high single digits of market share. And they've never really broken out of, from a brand perspective, being known as anything more than a cash back card. Compare that to Capital One, which is, has a much broader suite of credit card products out there. They're known for innovation. They're known for also lending to a much broader swath of the consumer credit spectrum. They also lend to small businesses. And I just see all of that as all of those things as positives. Getting back to the network, though, that I'm very interested in seeing what they do with that. You talk about a dynamic and innovative company like Capital One. Maybe they can do something with a proprietary network that gives them an advantage over the other banks that have to share the Visa and MasterCard networks. And that can happen in a way, for example, they could lower their prices to compete, to be more competitive, and maybe draw some activity on their proprietary network if they choose to keep it.
I think it's a great insight to call out. Look, Amex has a 17 times forward PE ratio. Capital One has a 10 and change forward PE ratio. One of the reasons why Amex is valuable is because of the network. And they earn economics every time someone swipes. Amex is getting 2.5% plus or minus what we call interchange income. All that is a racket and needs to go away through competition or blockchain or antitrust. I don't know what. None of those efforts ever work, by the way, as you know. Every 10 years, Congress says, maybe we should do something about this. It never happens, unfortunately, and obviously.
It has happened. I want to. This is actually a very present topic. So it happened in the debit card space. So you're right. It hasn't happened in credit card space. Right. In the debit card space, the Durbin Amendment occurred. What was that? That was about 10 years ago, I think.
Right.
And it didn't have the impact that I think they were hoping for. So, that was a case where the argument was these swipe fees were too high. They needed to lower them. So they did. They mandated them to be lowered. And the hope there was that merchants, because they now needed to pay less to accept certain debit card transactions, would pass the savings along to retail, to shoppers, people like you and me. A postmortem study by one of the feds was done a few years after that it took place, and they found that no such behavioral change occurred. What happened was the merchants just kept the difference, it looks like. Now, look, that is one study, and there are plenty of confounding elements to that study. I'll be the first to agree to that attack, but it is the only study that I've come upon that tried or attempted to answer the question, did this plan work as intended? And the answer is no, it did not.
I would say, if I'm a merchant, I have one menu of prices. Running a business is hard enough. And having two separate menus or having rewards incentives for cashback, sometimes gas stations do this, as you know, right?
Oh, they definitely do. I'm seeing it more and more. I walk into a place now. I'm not seeing it a lot, don't get me wrong, but I'm seeing it more often than I used to, where it will say in the door, different, either cash only, or they will say, we charge at X% for credit card purchases.
Signs of the times. Part of that's inflation. The other part, though, is gas stations sell one product, gas. So the menu is easier to manage. It's a commodity. They can get through that. But I to your point, though, if they are successful in elevating this network and capturing the economics on that, that's substantial. Now, I haven't studied Capital One closely. I don't know if that's part of the vision and plan. And obviously, to grow that business, you need what's called a big merchant acquiring network. Capital One does have good reach. There's, they're not a national brand. They don't have a national bank branch footprint, which helps you in growing your merchant footprint.
This Discover acquisition will help them in achieving that, I think, with that scale and reach.
Really interesting point.
The other thing I just wanted to point out, I mentioned that this was a clear and present kind of issue, is that people may not realize, but there is a bill wending its way through Congress as we speak that has bipartisan support. Durbin's name is on it again as one of the sponsors. Really? This is called the Credit Card Competition Act, the CCCA. And this is legislation that is aimed not at the debit card market, but at the credit card market. And really what they have in their sights is what they believe to be excess profit taking, or however you want to call it, by the Visa and MasterCard network. So they want to introduce legislatively mandated competition at the merchant level point of sale to allow those merchants to choose at their choice which network to run a given transaction on. So it would basically require every credit card to be able to run on the rails of any other network. The thinking there being that the merchant would choose the lesser cost, say, Discover network to run the transaction on, even if you're holding a Visa, MasterCard credit card. I see this again as not achieving the goal that it intends to achieve. You might see that the cheaper networks, for example, simply raise their prices so that there's no difference. I mean, that could be one outcome. But they've got smarter people than me that are on this and thinking about it. And it hasn't crossed the finish line yet, but it is actively, and you'll see it come up in the news every now and then. Now that I mentioned it, it comes up in the news every now and then as gaining momentum.
So if the merchant can choose which network to run, then that would impact the rewards points consumers get.
So zoom out. This is a great topic. However it comes about, if it's the CCCA, by the way, 2 weeks ago, Visa, MasterCard settled with a group of merchants to lower their swipe fees, maybe to take the wind out of the sails of the CCCA. I'm not sure.
Well, they always settle, right? That happens. Yeah. Then the antitrust goes away, right?
When you reduce the swipe fees, is my point. That's what pays for all the rewards programs.
Exactly.
To a large degree. Say goodbye to all those rewards programs, or maybe they just become less generous.
Well, the thing is, I think something that's lost on people, because everyone's attached to rewards. Like I've got 4 rewards cards. I got my United Mileage Plus for optimizing for this or that, the other thing.
Mm-hmm.
But competition will bring back those benefits in other ways, 2 ways. One is prices. Prices generally can be lower.
Yep.
Second is tailored merchant discounts. So you move the reward grantor from the credit card issuer to the merchant.
Yeah.
The merchant can have targeted offers and promotions, which they're in the business of doing now. We call them sales, but right. I mean, the net margin for a retailer, it's like 1% to 2%. If you're a corner bodega in Brooklyn, it's a 1% profit margin. We saw what happened. Hurricane Irene roll through the city. These are thinly capitalized small businesses that just disappear.
Right.
Because they don't have the capital. And restaurants similarly. I mean, there are like real American jobs and families that are impacted by that interchange rate. Now you're kind of pitting the consumer rewards against the merchant. What they really should just do, enable competition and enabling, I think, alternative forms of payment. I mean, I can move money. I prefer to move money with the stablecoin transfer rather than walking in my bank branch, especially during COVID. To walk into my bank branch and prove who I am and that I have lawful authority of these funds.
Right. Yeah.
Show me your signature didn't match to when you opened the account 15 years ago. I'm sorry. We need to how the hell did I write this thing? Like
I will tell you that zooming out, the bottom line is that credit card companies have a margin to preserve, and they have a lot of levers they can pull to preserve those margins. If they see one revenue stream, swipe fees, go down, they have many other ways of making up for that revenue stream, and they have or reducing the costs. As I mentioned, they could make their rewards less lucrative or generous to preserve those margins, and they absolutely will.
Right, they're already diluting rewards. That's already happening.
For sure, and that's probably more or less due to inflation, among other things. But yes,
right.
And airlines are making their programs less generous too.
Absolutely. So we'll have to keep a close eye on this. If that's passed, we have to see if there's any revenue impact to any credit card issuers, because interchange income is a material source of revenue, and it's high quality revenue. It's why they get the multiple. They're not getting the multiple for interest income on loan balances, because interest income on loan balances is risky. It's pro-cyclical. You get to set aside for losses on the rainy day. That could be a very material impact to the credit card industry. We'll have to keep a close look on that. Thank you for sharing that with us.
Sure.
Well, thanks. Well, this has been terrific. Really appreciate it. How can people follow you and learn more about your work?
Oh yeah, well you can like I have a newsletter. I've referenced it a couple of times. It's called Consumer Credit Matters. That's really again where I channel my passions and my opinions about what's happening in the consumer credit markets. As those topics descend upon us, they have, and I'm sure they will continue to do. It's just been an endless interesting sector to focus on, just because it matters so much to kind of the economic world in which we step out into every day. And so I really enjoy following it and talking about it. Thank you. I have to say, Ram, thank you very much for the opportunity to speak about it.
It's been great. And tell us about your consulting company. What do you specialize in? What do you focus on?
Same thing. So, going in any direction from, advising, consulting on the originator side, the issuer side, as well as investors, and just opining about what things are happening as I see them.
Terrific. Well, I hope you all enjoyed that. Will is first rate, known him for quite a long time. Always enjoyed your reports. I remember seeing Will present at the U.S. Treasury. I think it was back in 2015.
Oh, wow. That was a long time ago. Yes, I forgot about that. For some
reason, they invited me in that group, but you were on stage holding court there, and I thought it was a very thoughtful presentation. I said, I got to keep an eye on Will, and I've always enjoyed our get-togethers and staying in touch. So thank you for sharing your insight.
Anytime.
Very much appreciate it. Take care.
Thanks, Ram. Best of luck to you.
Thank you.
Have a good evening.
You too.
Bye-bye.
Thank you for listening in on the episode. Remember, in the world of investing, the road less traveled often leads to the greatest rewards. I'm Ram Ahluwalia, your host and Chief Investment Officer at Lumida Wealth, where we specialize in the craft of alternative investments. Invest wisely, stay ahead of the curve, and stay non-consensus.